Good morning, everybody. It is Friday morning, March 27th, and we are now probably 2 months into the coronavirus pandemic, and a lot of things have changed, and a lot of things in life are going to stay changed. So let's start with coronavirus and what it's going to change, and then we'll move on to markets and see where we are and what we should be thinking about. The first thing is there's an article in Medium by a healthcare guy, and he shows basically what we need to do to crush coronavirus. And it's basically we need about a 2-month period. This is from a couple of days ago. We need about a 2-month period where we dramatically reduce interaction. And right now, the whole state-by-state thing isn't working. States like New York and California have major outbreaks because of the nature of their mega cities. But then you go down to Louisiana, and they actually have the highest concentration per capita outbreak. And it just happens to coincide with Louisiana being the least educated place in the country. So whenever something bad happens in Louisiana, everybody always points that out. I think in this case, it might play because some of the politicians in Louisiana have basically been telling their people, you'll be all right. Don't worry about it. We don't need to shut things down. And they're getting it. And right now there are hospitals in New York and California and Georgia that the entire ICU units are full. So we know that if we don't bend this back, and right now we're on the red line. We're on this red line. If we don't bend this back in the next 2 weeks, for lack of a better word, we're screwed. There will end up being millions of infections if we don't bend this back in the next 2 weeks. And remember a month ago, I told you that the peak would be in April and May, and I told you what my theory was. My theory was that Fat Tuesday and that spring break would be major problems. Because you have all those people mingling on Fat Tuesday in many places, Mardi Gras. And then on spring break, I didn't think the millennials would take this seriously enough without having it forced down their throat. And I thought that they would go and do spring breaks, and then they'd come back to everywhere else in the country as carriers. And what we're seeing is that's exactly what happened and what is happening. And the millennials have even come up with a little term. It's called the boomer exterminator virus or something along those lines. Again, I implore you, if there's a millennial that went on spring break and they came back, don't let them in the house. And if they don't have it and a month goes by and you can be a carrier for a month, when you do get to talk to them again, start with slapping them in the head. Because the insanity, stupidity, and selfishness of people who are not segregating that may have been exposed, which is almost everybody, is beyond me. Because if we follow this red curve, this $2 trillion stimulus that we did is never, ever going to make a difference. We're going to have to do it again. So my guess, my educated guess, is that we are going to see a double dip recession because I don't think we're going to beat this down enough. And unless we get real lucky and the summer sunshine does it for us, which we don't know whether or not that'll happen. We do know there's some sensitivity to ultraviolet light, but really coronavirus isn't like the flu pathologically. It is, I think that's the right word. It is more like a walking pneumonia than it is a flu bug. So what we need to be aware of is while it transmits as easily as the flu, it sticks around longer. You can be infectious for a month. So we need to bend this over literally next 2 weeks, or we are in very, very big trouble. We are already to the point where the ICU units are getting stressed. So this chart, which I talked a little bit about on Tuesday, I think, I know I've shown this to some people, is that the red line is basically the number of ICU beds in the country. And we're probably going to have 200,000 ventilators within weeks. However, if we follow the red curve that I showed you above, and we end up with this many people in ICU in a month, we are going to need over 1 million ventilators at some point. So basically, everybody above where the words ICU patient starts, right? Imagine a line right there. Everybody above that line dies. So this area here, dead. Consumer confidence plunged today because I think people are starting to realize this and what it will do to the economy. Massive medical bills. I mean, you're literally going to have hospitals that are going to have to be bailed out by the government, which I think they will be a lot more money, right? Financial show. So we got to talk about the money. But we're talking about millions of people dead. And as I talked about off the air, you know, there are conspiracy theories out there about, oh, well, this is actually good. And all I can say to those people who buy into the whole we need to get rid of people because we can't afford them, again, if you believe that, cancel my service. I don't want to help you make money. And trust me, as an ex-baseball player and current poker player, it's very hard not to swear at you and call you other things. So if from an ethical standpoint, you have any question that this is wrong to let these people die, please walk away from me. So Leon Cooperman, one of the resident old man idiot billionaires, was on CNN this morning before the market opened. He said he's optimistic that the stock market has bottomed on coronavirus fears. He's another guy that backs President Trump, gets to talk to him once in a while. And I would just like to point out that the stock market's down 1,000 points half an hour after he said that. Once again, I will tell you, there are a lot of rich people out there who are very good at their job. Or they are the beneficiaries of a rich father or a rich mother of inheritance. Or they are just in the right place at the right time. And Leon Cooperman is one of those things as far as I'm concerned. And I've been saying this for years and years and years. 20 or 30 of these guys who run around giving opinions because they're rich enough that people will listen to them. Some of the smartest people I know, iron workers and engineers and nurses and doctors and people all walks of life. and they just didn't have the desire, or didn't pick that to go and just get filthy rich when they were young. And they didn't have those opportunities. They didn't go to that right school. They didn't have that hookup. And a lot of this is who you know, not what you know. Stop listening to some of these imbeciles who would lead you down a dark path, and that many of them, right, they're so concerned about their next $1 billion or next $100 million that they'll lie to try to impact the market so they can make a trade that they want to make. Look at Reddit, right? And you get to the other end of the scale, and it's not a bunch of rich guys, although I think a lot of the ideas are planted by rich guys. I'm going to write about this. Reddit is the blogging network. Not really a blogging network. It's just a giant bulletin board. And they have been pumping up stocks and then crashing them using options and groupthink and group trading, that if it were professionals doing it, it would put the professionals in jail. But these guys get away with it. And as I tell you, the manipulations in the stock market are many and great and largely underappreciated by most of the people in the market. One of the things that we can do is ignore the idiot sons, ignore the noise, and focus on the big picture, and then try to figure out where the market distortions are. As I've said over and over and over again, and I'll repeat right now, what part of the market do you want to stay out of? Somebody put it in the chat, make me feel better about myself. That's right. Stay out of the middle of the market. Trying to guess which way things are going to go when the prices are in the middle is a bad strategy. We need to wait for more extreme pricing and clearer to the edge signals to buy or to sell. And the stuff in the middle is just too hard to deal with. If you're a Charlie Munger fan, what does he say? Some decisions are just too hard. We'll go to the next one. So when you're taking a look at stocks out there, you're like, oh, I wonder if I should buy this right. If you have to wonder, don't do it. If you can't get a chart set up where the three things that we look at are all in alignment over multiple time frames, skip it. Wait for it to come to you. Don't chase prices. Don't chase yields. Don't fall for the hype. And for sure, don't listen to the idiot sons. And most of all, I think right now, be aware of what's pushing the market around, which is traders and algorithms. Because mom and pa investor, you don't matter too much. You're just a little bit of money. The institutions, the algorithms, supercomputers, high frequency traders, right? That group. And then the swing traders and day traders are the ones moving the market. We can make money waiting for them to go to an extreme. And understand how trading works. You get the guys that put in the first trade, they create a narrative, it permeates the internet, they get a whole bunch of chasers to chase, and then without telling them, they switch directions when it gets to the point they want to switch, when it gets to an extreme. And they get their trades on, they take their profits, they put their new trades on. This all takes a day or two. And then they come back with a new narrative. And they push it down. That's all on top of what is systematically a weak stock market in a weak economy. The whole slow growth forever economy is important for you to understand. And if you don't, go read my article at my Blue Mound Asset Management page, or I have it broken into two pieces on Seeking Alpha. Slow growth forever, put it in quotation marks, then put my last name after it. It'll pop up. That's the structural flaws in the economy that we've allowed to grow for the last 40 years. Since the early 19th, since 1981, the economy has structurally been getting weaker, not stronger. It's only because we're the United States of America, blessed with the best geography, the best enough system, good enough system, and not threatened, and we have all the resources and a great workforce. We have allowed so much of this economy to be skimmed by about 1% of the population that everything that's gone right for you and people you know in the last 40 years has been incidental. It's been the schnibbles that we are allowed to have. I'll give you a couple interesting statistics. The debt of the United States has increased about $54 trillion since 1981. The net worth of the richest 1% of the people in the country has increased by about $18 trillion. What does that mean? That means that about 3/4 of the money that this nation has borrowed has been handed over to 1% of the population. A few trillion more of that has gone to China. Another trillion or so around the rest of the world. And basically the middle class has gotten nothing. Net of inflation, the average pay increase of everybody outside of the top 1% has been about 1% per year. But if you're in the 1%, your income has gone up somewhere between 3 and 60-fold. Now, I'm a lucky guy. I'm probably going to get there. Barely. I'll be like at the very edge of the 1% if I keep grinding it for years to come. I'll have that one moment. You know, I'll make utility infielder money someday for a year. I hope so. Utility infielders make like $750,000 a year. So keep an eye on the big picture through this. And the big picture now, apparently we're not going to shake hands anymore, is that the world's going to change, and really has already changed. So coronavirus has accelerated a lot of things that were already going to happen. We've already talked about the 5G, IoT, AI economy, and what is coming with that. Well, consider what's going on now in corporate America. Corporate America is letting people work from home. I just talked to a guy out in Los Angeles area. His company bought them all laptops and sent them home. Just bought, I don't know how, 600 laptops he said they bought. Here's 600 corporate laptops, go home and work. And if you guys keep making money and you're efficient, you'll be able to work from home somewhere between 1 and 3 days a week when this is all over with. CenturyLink, a company that we have a small position in, 75% of their people are working from home. Most of the IT world, the technology world, most of their people are working from home. Think about the impact that that's going to have on a lot of different things. We'll get to that in just a second. So, big picture is go through articles, see how the world's going to change. I'm going to just walk through it. I gave you the big picture. But go through these articles. This one on Guardian. The Guardian's a pretty good paper. It is one of the ones I pay for. It's cheap. It's under $100 a year. Cities after coronavirus. And this is important. Whenever I've said, after some of my trips, I've asked, why don't 1 million people move out of New York City? right? It's dirty. Yeah, it's not as dirty as a Chinese city, but it's still dirty. They throw everybody carries out their trash to the curb, every night. There's rats all over the place. It's not healthy to live like this. It's just not. And it's exciting and it's fun. If you're young, you can go out and do things. Right? I'm getting old. This is not a healthy way to live. We have a giant country. Urban sprawl is good. You know why? Because you have some space, you have some clean air, you have some privacy, you have lower stress, less latent lighting. I think that's the term, right? The ambient lighting. So a lot of things are going to change. Cities are going to change a lot. The old argument about why we needed to all live on top of each other is so we conserve resources. Well, what we're finding now is that energy is dirt cheap and probably dirt cheap forever. We don't have to do it for climate change anymore. We're going to all drive EVs in the 2030s. If we were smart, we'd build a couple more trains. So you could live, there's cities on the East Coast that do this, but you could live 30 or 40 or 50 miles from where you work if you have to go into once in a while or to the shop or whatever. There's a lot of things that make sense that I've said, because they make sense, they'll eventually happen. And that's what we're about to see. We're about to see a lot of things that were slow to come a lot faster. So read these articles out there about how coronavirus will change the world. This one on Politico is actually very good. The one on the Washington Post is awesome. If you have Amazon Prime, it's like for $40 a year, you can get the Washington Post. Get the Washington Post. Set any ideology aside. And I will say, the Washington Post and the New York Times have both gone dramatically out of their way to not be biased. Yeah, you can't get rid of all of it in either direction ever. But the Washington Post and New York Times, I'll tell you what, they're cheap to be able to buy. And I can't recommend either one of them more. I get them both through my Amazon membership for, I think both of them $150 a year combined. So take a look at these. Los Angeles Times has all kinds of coverage. The Los Angeles Times, I will say, that this is probably the next best paper in the world after the Times and the Post. So, and I think this is part of one of those groups. 10 ways coronavirus, all these articles out there. All you gotta do is Google coronavirus change, how we live, the world, anything like that. So this one, if you're gonna read something, if you're only gonna pick one, I think this is the one. Go to MIT and read what they're saying. Okay, so the MIT piece, go take a look at that. We're not going back to normal. They didn't do a great job of search engine optimization here, but they throw coronavirus in a bunch. Read this article. It's not even that long. It's shorter than most of my articles. All right. So the market is having a bad day. Right? Where are my indexes? There we go. So the Dow is down 591 right now. NASDAQ's down. So it's not a horrible day. This isn't as bad as it can get. This is people taking some profits that were trading this week. But what we saw today is that the consumer confidence came in very low. So I would take a look at that. I don't think people are confident, and that doesn't lend well to money getting invested. And in the next 3 or 4 or 5 weeks, we're going to see all the corporations come out with their earnings and their earnings revisions and their outlooks. They're not going to be good. And even though the Fed has got $4 trillion they're putting to work, it's going to be the biggest expansion of the money supply and the Fed's balance sheet ever. I think you need to realize what they're doing. This isn't quantitative easing to stimulate the economy. This is quantitative easing to prevent the outright collapse of the credit markets again. So this isn't an after-the-fact rescue. This is to try to prevent a collapse, and it'll probably be successful. But it's not going to leave all kinds of money to push markets back up. We're not likely to see a V-shaped recovery. We're more likely to see two different types of recoveries at the same time. You're going to have certain investments in parts of the economy that thrive and get kind of a U-shaped recovery. It won't be quite V-ish. It'll be stretched out for several more months, but then it'll do pretty well after the election or into next year. Then you have the zombie parts of the economy. Slow growth, no growth, high debt, capital-intensive businesses, those grandpa companies, those grandpa stocks, and they're in trouble. That's going to be an L-shaped recovery. What that means is they've come down, and they're going to stay down. And they'll live because we're putting so much money into the system and doing so much, that is doing as much as we can to keep people employed. But those companies aren't going to make money for shareholders ever again. And eventually some of them are going to fall off a cliff. And at some point, we're going to short those into oblivion and probably make some money. So if you're a fundamental trends subscriber in the rare service and you want to do some of these swing trades, for the last several months, I've told you to avoid the swing trades because something bad was coming. And I wish I could have done this whole thing short better. I know some people bought puts. I had a couple puts. But for the most part, this happened so fast, it was hard to prepare for. So to make money on this, you had to make a trade in the middle and get it right. So for those of you who did, there'll be companies that we can pick out that we'll be able to look at and just go, oh man, this one's going to drop 90%. And we'll do that. One of the things that I think is going to be fairly obvious as this plays out is that if your asset allocation is S&P 500 weighted, you're just going to be running in place. So all these people with Vanguard who are super duper diversified across everything, they're going to have another decade like the 2000s. They're not going to make any money. They're going to average 2 or 3%. You need to get out of the worst parts of the economy and never look back. So I have tried to say this for the last 6 months, and I'm just putting the hammer down on it now. If you own old man stocks, old grandpa stocks, whatever I called them a couple of years ago, you're screwing yourself. It's just screwing yourself. The banks are done going up. They're going to chop along or go down for a long, long time. If you want a bank, buy Apple. More money, better business model, less risk. Growing dividend, buying back shares. Buffett is a major shareholder, just like he is in the banks. But he's cut his holdings in Wells Fargo. And maybe he's adding to some of these banks now. But I've told you, Buffett isn't all about the money anymore. Old people that he's just going to track the S&P 500. Why would he do that? He's just trying to influence corporate America. He's a left-of-center guy. He's the richest guy in the world, and he's decided to use investor money and his money to influence the world. And the banks have a lot of power. Why would he invest in Walmart? Giant employer, right? It's a giant employer. Might be the biggest employer in the world, or at least in America. He wants to influence things, even after he's dead. And that's why the trust, his company is set up the way it is with the people that it is. So keep that in mind with Buffett, because I hear how Buffett invests all the time. They're wrong. Warren Buffett was always a growth investor, but he was doing what we do. We look for growth stocks that are trading at a value price. That doesn't make us a value investor. It makes us smart. Don't buy old man grandpa stocks because they're cheap right now. They deserve to be cheap. They didn't deserve to go up the way they did. Now, right now, on this chart that I've showed you a million times from this level, this chart is 2.5 years old, by the way. So everything that I predicted is happening. The only thing that I don't know is if we're going to get to this level here. That's 16, 17, 1800 on the S&P 500. That would imply a significant financial crisis-like event. I think we're there. I think we're going to see this 16, 17, 1800 on the S&P 500. In this webinar from Tuesday night, so Tuesday night webinar we do for stock investing and option investing. And it's going to, in the future, be on a private link that by the time it gets shared with people, with their friends, it'll, I don't care too much about that limited sharing. I mean, I don't want you to do it, but, whatever. It's not going to be out there for the public. I think we're going to be able to make some pretty good trades as we come down, out the new companies, and we go back up. But again, slow rise here. By the way, if you're a margin of safety investing investor and you want to do some of the swing trading over at Fundamental Trends, I thought about how to help you out with that. What I can do is give you like a 90% discount, for like $99. I'll let you do a snap-on sort of thing. So you don't, because I know that a lot of people like margin of safety. They like the chat room, and I like, because you're already in Seeking Alpha. I'll give you access to, if you want to maintain 2 subscriptions, I'll give you like an add-on for like $99 a year or something. So if you want to take part in the swings too, but really it's not your main thing, it's just something you want added on. All right. Anyway, I told you on Tuesday night this rally wasn't going to last. I do think we're going down to this line. I could be wrong. Maybe there's enough stimulus to prevent that. But I think we need to watch the corporate reports in April. And I think that's going to matter a lot. And we have to go back to that whole, are we really going to let this disease spread? I was talking to somebody that I'm working with on an investment plan, and he's in the Dominican Republic, and he said Americans just aren't ready about to hit them. I think I agree with him. I don't think we're ready to see the number of infections. The images that are going to come out are people waiting outside of hospitals, doctors talking about full ICUs, nurses talking about not having the proper protection equipment. I just talked to one yesterday, and my girlfriend talked to one yesterday as well. There's not enough gloves. There's not enough protective masks. On top of that, having enough ventilators. People are going to die. This is not going to look pretty in the next 2 to 3, 4 weeks because we're not doing everything that we should to beat this down. And I think that's going to have a major impact on because confidence levels will drop even further. The other thing is I've actually read about 200 pages of the relief bill now out of 880. It's 880 pages, which is not bad. They got it down from 1,500 to 880, and it's double spaced. You know, it's really only about a 400-page read. I'm halfway done. I'm a quarter of the way done. That money is not going to get into the economy quick. It's going to trickle in over the next 2, 3, 4 months. And something to keep in mind is even TARP back from 2008, it's still active. And there's still, I think it was like 70 billion? I think $70 billion that never was allocated from TARP, from the original 700 billion. This is going to be the same way. And just a side note, if you're a small business person, you need to take a look at this, because you can borrow money for under 4%. You don't have to make any payments for a year. You can make the payment, you can pay it off over 15 years. You don't have to put a personal guarantee on it. You just have to attach it to your company, your LLC, whatever it is you have. And you get a $10,000 advance pretty quick. And if they don't approve your loan after the fact, you don't have to repay the $10,000 advance. So if you're a small business, even if you're doing okay, go get involved with this. It'll help you refinance debt. It'll help you improve your business coming out of this, whatever. Make sure you take a look at this. Go talk to your local banker. There's all kinds of bankers that are doing this. The bankers will facilitate this through the Small Business Administration. You don't actually have to go directly to the SBA. All right, let's get to investing. My next article, Coronavirus has changed investing forever. Here are the things we got to pay attention to. The 5G IoT adoption, oil demand growth is just about over with, and office REITs are going to face lower occupancy and lower rents in coming years. If you focus on just these three things, what you're going to find is great investments to go up, all sorts of oil companies to short back into the ground, and office REITs, for the most part, you ought to just avoid them. But I'm looking for companies that I think might collapse. There's going to be 1 or 2 or 3 or 4 or 5 or 10. So these are the three big investment things I think you should focus on. People working from home. That's it, just bottom line, people working from home. How's that going to change this adoption? People working from home, how is it going to impact oil growth? People working from home, how does that impact office rents and occupancy? A couple years ago, I talked about helicopter money is inevitable, gave this interview. If you haven't listened to it yet, listen to it. You know, spend the 40 minutes on this. I think it's 40 minutes. He does a little summary here. It was actually his mistake, not mine, corrected. He made it sound like it was my mistake, but it was his mistake. But take a look at this. Take a listen. Because what just happened in the most recent I wrote, the helicopter money is here, right? The money on the Federal Reserve balance sheet will never be paid back. Ever, ever, ever. At some point, they'll just helicopter money it again. At some point, they'll actually print the money instead of putting the debit on the other side of the ledger. The debits on the other side of the ledger are imaginary. They're never getting repaid. So they have to figure that into monetary inflation. Which is why I think there's a massive gold bull market just starting. The opportunities that you've gotten to buy gold on the cheap here recently have been because of margin calls. So people get into trouble, institutions get into trouble, they have to liquidate assets to pay back their margin loan. Gold stocks had held up and gold has held up, so that's what gets liquidated. And then they have those big one-day sell-offs of 15%. And people run around going, oh, it's broken. That market's broken. No, it's just a margin call. It's the thing that still had value, so they had to sell it all in one day. So on those days, you want to buy it. 2 Mondays ago, when I did the Forex Analytics show, before the market opened, we knew that gold was going to crash. And I said, I'm going to buy it right now. As soon as I get off the air, I'm going to go out and buy it. As soon as the market opened, I was buying gold stocks. I sent out an alert to everybody. I know a whole bunch of people got gold GDX under 20 or right around 20. Some of us, because we were paying attention right at that minute, were able to get it at 17. So my cost basis in GDX is just a couple pennies over 20 right now. And that's really what I think you should be shooting for. As the margin calls come, if the market weakens again in the next week or 2 or 3 or 4, anytime you get GDX near 20, that's what you should be doing. So I'll get to that chart in just a second, but first the public service. What I'm seeing right now is what I saw in 2000, whatever it was, 8, 9, 10, 11, when everybody was doing the whole gold thing. Buy my gold, buy gold here, buy these gold coins, buy this gold, that gold, the other gold. Well, keep it simple, stupid. All right? First of all, we're never going to use gold as money. Right? You don't have to buy gold bars. You need physical gold. I'm not telling you don't have some physical gold. If you want to buy a really cool Cougaran set or something like that you can pass on to the grandkids, cool. It'll always have value. Somebody, you can sell it at some point if you need to. Never going to get traded. But it's a pretty good store of wealth. And it'll come up, it'll go up and down, and first it's going to go up. Why? Because this. All the inflation for new money. But my public service announcement is don't fall for those hucksters. This gold supply guys, F, Better Business Bureau. And a lot of them are scam artists. Most of them are scam artists. So be very careful if you want to buy a nice gold coin set, whether it's Cougarans or U.S. stuff or whatever, or Spanish, whatever. There's cool golds out there. That's fun to look at once in a while and show people. I was at a guy's house. He had a whole Cougaran set from years and years ago, and it was neat. You know, I mean, yeah, it was something that just look at while you're having a drink. But really, you don't really need physical gold. So don't fall for any of these guys with the big markups and fees and storage fees and all this other garbage. But you do want gold. Why? Gold bars are, gold production is slowed down. So there are shortages of gold for the new demand that's out there. This is Financial Times talking about it, Market Watch, Wall Street Journal, Bloomberg, all talking about it. So that's even affecting the crypto market because there's a coin out there tied to gold. And Bitcoin's been all over the place. We're not going to talk much about that today. So be careful, because they're going to create a hype and they're going to try to get you to buy the wrong stuff. Right? There'll be all kinds of those internet ads, radio ads, TV ads. Buy your gold here. World Gold Council is a good place to go for information. What we know is that gold supply is going to be tight for a long time because of what's happened in that industry that we've talked about over and over again with the consolidation. So let's take a look at gold and gold miners. I think that the price of gold is going to go up to about 3,000. Somebody stole that from me and actually wrote an article with gold going to 3,000 in the title. I think it's interesting that exactly what I said, somebody else wrote a week later. I think that we can try to buy gold. I don't know if we have to wait for a weekly oversold. I think that if we can get gold on a daily oversold, right, this spot right here, maybe we should have bought the gold. We'll get another daily oversold because this is as low as it got before. So I don't know if we're going to get a 30 on the RSI on the weekly chart. But if we're in the middle here, that'd be one of the rare instances where I'd be okay, because on the very long range, we're doing pretty good. Right? So a pullback down into here is probably worth buying. See where that line right there? It could get all the way down here. It could. I don't think so, though. I think gold is in a new bull market. I think this curve keeps going up. And I think because essentially we're going to end up doubling the money supply on the planet again, price of gold goes to around 3,000 in the next year or two. So we're going to be working on some option strategies around that over at Fundamental Trends. But I think just adding GLD to your portfolio is probably a worthwhile thing to do. And I think you have to for sure wait for a daily oversold. You got to get the daily oversold. And you might only get it for a day or two. And you need the weekly and the monthly to at least come down towards the middle somewhere. Because I don't think we're going to get this again. Not for quite a while. You have to get a good run up for it to come back down like that. The gold miners are leveraged to the price of gold. And I think that's important for you to understand the relationship between gold and gold miners. Gold miners are producing gold at about $1,000 an ounce to get it out of the ground. Right? So as the price of gold goes up, all that extra money just falls to the bottom line of these corporations. So you can do some pretty easy back-of-the-napkin calculations. Say, okay, I'm going to go over to Newmont Gold or Barrick, right? Newmont Gold Corp or Barrick Gold. And I'm going to say they produce X amount of ounces a year with 2%, 3% growth rate on how much they're producing. And this is how much money they make at $1,000, zero. This is how much they make at $1,500 an ounce, at $1,800 an ounce, at $2,000 an ounce, right? And at $2,000 an ounce, that's a breakout because the previous high was in like 1910. The price was 1910, not the year 1910. That's why I think it goes to 3,000. Not only the monetary factors, but the fact that that's just a technical breakout that people will pile onto. So if their profits double as the price goes from 1,500 an ounce to 2,000 an ounce, there you go. Profit doubled. And at 2,500 an ounce, their profits tripled. And at 3,000 an ounce, their profits quadrupled. So this can go pretty high. And I will put out the earnings, a little earnings chart to show you what the group and what a couple of individual companies will do. The most recent article I actually put in, oh, it was right there. I actually have a chart in here, right, about correlations. I think interest rates are going to end up going up in the next year or two. You know, maybe not this year, but probably by next year. Because of all this money being printed, what that means is that there's a lot of crowding out going on. And the crowding out means that you are going to have a hard time justifying being in bonds. So the bond vigilantes, the people who demand some interest for the bonds are going to want more of an interest rate. That's one of the reasons why the U.S. Treasury has had a higher rate than everybody else in the world. Negative rates don't make any economic sense, no matter what they argue. It's just a wrong thing to do because it eliminates the hurdle for risk-taking, and you have to have some hurdle. It doesn't have to be a big hurdle, but it shouldn't be something that you can't even trip over because then you get a lot of malinvestment. And that's what we're seeing with the repo market is all these clowns that levered up, the Fed bailed them out. That's what the repo market was doing. I've been telling you that for months. There's been a lot of stealth bailouts, and now they're just above board with it. You know, they're actually using coronavirus as a bit of a cover to bail out all these companies that got levered up. And I actually don't think I put it into a free article, but somebody brought it up yesterday. Let's see if I can find keyword AQR. There you go. Back in January, I talked about this. I showed all the hedge funds, and I pointed to the ones that I thought were possibly in trouble. I don't think Bridgewater, Renaissance are in trouble, although we subsequently found out that Bridgewater did have problems, which surprised me. But AQR was getting crushed last year, and actually one guy wrote a pretty good article about it. So if you're a subscriber, just go to Not QE and the Repo Monster. It's just a note, but it talks about what was happening in the repos. So with the gold, these miners, on every pullback, you should buy it. And I think that right around 20, 21, I mean, you might get lucky and get it down here. You have to be in front of your computer that day. But I would be setting limit orders at, say, $21 and then just set it and forget it. You know, right now with the market this active, you shouldn't actually be ignoring it even for a day. Look at your orders every single day until we have our positions reestablished, right? We were lucky that a lot of us were in cash coming into this. But at some point, you know, you just let it ride. But I think 21 is about where you're looking to buy GDX. All right, let's talk about one more impact here, and that's the oil market. I wrote back in November the peak oil plateau is close. Interesting that the International Energy Agency would use that word. Look at that. Peak oil supply set to plateau. And that coincides with the drop in demand. So the IEA is forecasting that oil demand is going to drop by 2 to 3 million barrels a day this year. So this is from a little while ago. They've revised it up a bit, right? So 2.5 million barrels a day. They do talk about it there. So I go to the sorry, that's a talking wet cough. Somebody just posted cash is trash. Yeah. Yeah, Ray Dalio said that in January, huh? Yeah. I told you Ray Dalio was wrong on that one. So what we need to do is understand the outlook for oil is negative across the board. Oil demand is going to decline massively. The IEA has good stuff out there now. Even though you only get the abbreviations, you don't get the full report. Just read the short report, the executive summaries. Oil report. So just go ahead and read this. It's full of good stuff. XOP, I told you a couple webinars ago, was not going to exist at some point. Take a look at the list of these companies. None of these gas companies are going to make money for years. Why? Because the associated gas from oil production is just going to keep coming onto the market until oil production turns over, and really, really turns over. There's going to be a hit to oil production short term because a lot of these companies on the oil side will go bankrupt, but the gas companies aren't going to make money on this for a while. I think I said in the 2030s. It's probably sooner than that. But you're going to be able to get a lot of these companies. Somebody just bought this one. If they don't go out of business, right? If they're bankrupt, they won't go out of business, so let's go bankrupt. You have to take a look at their debt profile. Is Southwestern Energy going to go through a bankruptcy and have to recapitalize all their shares? That's the risk. And I'm not saying that $1.70 isn't a good deal. If they stay in business without a bankruptcy, it's probably a good deal down in here. But take a look at their different ratings. Take a look at their debt to equity. These guys are probably in trouble. So just take a look at I just picked these guys at random. If you take a look at their debt, just total liabilities, $3.5 billion, $2.5 billion is long term. Take a look at their assets. Their assets surely aren't really worth that much. That's just what they say they're worth. Right? You can't really hide the debts. The assets you can fudge. So take a look at goodwill. Where's goodwill? Any goodwill here? Well, I haven't looked at this close enough. But companies in general, you have to be very careful with. A lot of these companies, Exxon, I think Exxon heads down to between $10 and $20 a share imminently. Pioneer probably survives. ConocoPhillips survives. But I can't say that about a bunch of these other companies. Do we know that Occidental is not going to go through a bankruptcy? Do we know that some of these other companies aren't going to go through bankruptcies? We don't know that. The price of oil is going to stay under $40 a barrel for a couple of years unless there's a war in the Middle East. None of these companies are going to be profitable this year. And what if none of them are profitable next year? What bank is going to lend them money anymore? Banks are already telling them no. They get their credit line reviews next month. The banks might tell these companies, hey, here's the deal. We're not giving you any more money. Go through bankruptcy, wipe out the shareholders, and then we'll take part ownership of the company, right, in the bankruptcy. Because they're not going to get their money back if the shareholders exist. The banks need to become the new shareholders. That's the only decision they're going to have available to them because oil's not coming back. Because we know the oil demand is going to be flat and turn over by sometime late this decade. So with the exception of the Permian-focused companies, EOG is a low-cost provider too. The shale companies have a problem if they're not in the Permian. And even EOG, remember, you still have to keep drilling new wells. And the best drilling spots are done. They've been used. The high grading has wiped out the first tier of oil. Shale's costs aren't going down anymore. They're starting to go back up. So unless you're in the super cheap Permian, you're in trouble. The one thing that will save Occidental from a bankruptcy is A, if that's in Carl Icahn's best interest, and B, the things that I pointed out before with them, their CO2 business and their conventional business. They have a lot of conventional business. That's where they started. So I think they can shrink that company, and maybe the shares stop going down and rebound at some point just by shrinking it as much as possible. Then 2, 3, 4 years out, it comes back. But I don't know. I think you can make your money back in different places, which is what I said a couple months ago. This gap right here for XOP, that's That's death. So can it get back up to about $10 a share? Maybe. So that'd be about 20% rally in share prices. If you get that chance to sell, sell. You know, certain companies will go more than 20%, certain companies won't. But once XOP gets to about 10, you need to take a look at your stocks and see if you want to try to get out of them. My advice would be get out of them. Here's the interesting speculation, and we'll work at this on this at fundamental trends too. And again, if you're a margin of safety investor and you want access to some of the swing trades, I'll set up a special discount for you over on margin of safety, so you can just do the fundamental trends as an add-on. Oil is super cheap, and it's in contango. And there's oil being stored all over the world on these tankers, which have a short-term boost. So the tankers around the world are going to do really well for a year or two, and then they're going to crash again just like they did last time. So, and I don't even know that there's any trade left in that. The trade that I think is interesting is this. If you're willing to follow the news in the Middle East twice a day, every day, morning and night, I think there's going to be a hot minute where you can buy calls on USO or DBO, or oil, and I think that you might be able to get a pop on speculating on when the pressure in the Middle East is finally going to get to Saudi Arabia. And when is Saudi Arabia going to say enough is enough and bomb Iran and just say this is for last year? This is us being patient and getting it back at you now. So I think that could be coming. It makes sense for it to happen after Labor Day, especially if there's still close ties or some ties between the Saudis and President Trump. If you take a look at all the moving pieces here, it wouldn't surprise me if President Trump has said, "Look, we'll take care. You can go ahead and take care of Iran, and we'll protect you, but do it going into the election, so that A, we have the low oil prices in the summer, which isn't going to matter this year because hardly anybody's going to travel, and B, so I can look like a wartime president. Wartime presidents often win, and right now, President Trump is so far behind in all the polls that I think matter, and the internal polling that they do, and I know what the Republicans are seeing. I think he's desperate. I think he's going to be desperate. So just keep an eye on the desperation levels of the Saudi Arabians and President Trump come August, September, because then you might have a speculative trade that you could make in oil. But you need to watch the contango and the backwardation. If the contango starts to shrink, then that's something that could be a signal. All right. I will actually take a couple questions today. So let me scroll through here in the chat. And if you had a question, you need to throw it up again right now, because I'm not going to be able to find everything in this chat. Oh, somebody mentioned that the U.S. government's the biggest employer. Yeah, I suppose. Thoughts on TZA? What is TZA? Enphase. Yeah, I like Enphase. All right, somebody beat you to it. What is TZA? Oh, geez. Are you a day trader? Do you know how to use charts by the hour and minutes? I mean, anything can be done. I sure won't hold it overnight. I think this bill is going to be great for small business. So I think small business might be one of the first things that rallies coming out of this. FCMI. I don't even know what that is. SMCI. No, I haven't really talked about this. I do think that mid caps are the place that we're going to be looking, though, right? Oh, this is super micro. Oh, I'm sorry, super micro. No, actually, I asked Dave Zanoni to do a SWOT analysis on this, and I've actually just started reading all their documents. Oh, you should put this up there. This is going to be one of our secret stocks. This is a company that might really benefit from the 5G IoT AI thing. I haven't done all the research yet, so I don't know. But I think that they're well positioned, and if we can get them back down here, we have a chance. This is the wrong chart, though. Whatever. I got the symbol wrong. I think AT&T on under 30 is a buy. Can it get down to 27 again? Maybe. Remember, they're going to sell Time Warner. They have an asset there that has no value. That has value, but doesn't have value. The market's not valuing Warner Brothers. All AT&T has to do is get enough people on their network using Warner Brothers in the short term, right, with their HBO and things like that, and then sell it. They're just going to flip Warner Brothers. I don't know how fast, but when they flip Warner Brothers and Apple buys it or Amazon buys it or Google buys it or whoever buys it, whoever buys Warner Brothers, that's going to be just a windfall cash event for AT&T. They will wipe out a whole bunch of their debt, and they'll probably pay a special dividend. And from that point on, they just raise prices. They're just going to raise prices on internet access. That's all that's going to happen. They're building out this network. Their capital expenses are going to drop. They're going to increase what you're paying for internet access by $2 and then $5 and then $10. That's all they have to do. So I like AT&T better than Verizon because Verizon doesn't have a giant asset that they can sell. AT&T does. And CenturyLink can sell its whole darn business or all the physical assets and then just be an enterprise company, which is what I think they should do and what I think they're going to do. I think they're going to sell all their physical assets and just be an enterprise company. So, no. So people are asking about covered calls on oil companies. I don't think you sell covered calls on oil companies. I just think you look for a pop between now and year end. You try to get out with 20 or 30% more of your money back. No, I don't think Apple's at risk from a Cold War with China. As I've talked about many times, it's going to be very easy for Apple to move production to North America. Very easy. The shift that is coming, and I've alluded to the supply chain 100 times, right? Supply chains are going to move back to where their customers are. So Apple doesn't make the margins in China that they make everywhere else. People are still going to want iPhones there, so they'll keep their market there. I don't think that, they're going to go to zero, but they've already had erosion of market share. So where can they do well? And it's in the Western world. And they're going to move a lot of their production back over here. The Foxconn plant in Wisconsin is something that could be expanded to make iPhones. So we'll see. I've pushed for that. And, I've sent messages to Tony Evers' office. I'm sure they haven't gotten read. I think they probably got read. And I've sent stuff to Apple. I don't think those got read. But, no, I think Apple's in great shape. They have a pile of money. Better business than any of the banks. So, take a look at Apple share prices. And, I said 220 is probably a price to buy, and then down here in the 190s. I wish I had bought on that super low day, right? It got down to under 220. So if it gets back down under 220, then we have to be concerned that it has another dunk. It gets down here into the 170s. It could get all the way to the 170s. I'd buy it for sure in the 170s. So I originally bought it at 57. I wrote an article on Market Watch telling everybody to buy it at 57. Right in here, must have been right around there. Then I sold it at 120 because I am a chicken. I don't know where we got the 120s. Down in here. So I haven't owned Apple in a while. But it looks to me like that's probably the bottom right here. But I actually think this level right here, see, hits, bounces off, goes through, comes back up, holds it a while, and then breaks out. So that line right here, about 170, 123, I think that's probably as low as Apple goes. And I'm not so sure it'll get there. But if it does, you should probably buy it because it's better than any bank in the world. Why is there a US dollar shortage in the world? Because it's being sucked up by all the bad debt. Somebody says I had a limit order on Apple fill at 220. You are the man. So I've really been thinking about the casinos in Vegas and things like that. And internet gaming and all sorts of other gaming. Was my bottom fishing price on Apple 220? Oh, yeah. Oh, boy. Look at that. I had the exact bottom fishing price, right? I've had a bunch of those pretty close. Yeah, I should have bought it. That was my fault. I should have had it in the retirement growth and income accounts. We'll see. You get another chance. Like I said, I'm skeptical that we've got a bottom in. I am warming up to Facebook, Mr. Zanoni. So we'll take a look at Facebook in the near future. It's just, I don't think I'll buy it because they don't pay a dividend, but it makes me feel much more comfortable with wanting to buy QQQ soon instead of finding a replacement. So I think Facebook, with the way the world's going to change, is going to be a beneficiary. And with all the different platforms they have, even if they have to sell something or spin something off, they'll maintain a relationship. So, yeah, so let's take a look at CTL and then we'll call it a day. Remember, the thesis on CTL is that their assets are so good that somebody's going to want to buy them. So they're double bottoming here, right? It's a double bottom, bam, bam. So I think right here, if you're not buying CenturyLink, you'll never buy them. I just think this is a pretty good spot to buy them on a double bottom. They're oversold on the weekly, the daily, and almost on the monthly. And in a couple days, that'll be oversold on the monthly as well. So I think that you can front run this one, buy this one before the end of the month, maybe right on the 31st or the 30th. Even if they reduce their dividend, which I don't really think they need to do, their expenses went up a little bit because of coronavirus, but their revenues aren't going to really change. So you see, I got the red line in there already. That's why I like TradingView. I'm telling you, if you're a subscriber to me, go to the pages where I have the discount link for TradingView and at least buy the basic service. You don't have to buy all the pro stuff and all the upgrades, but that first one that's super cheap, you should have that. You should learn how to do this, how to track your, because this just pops up because I had it in there. It knows that I want to see that line on CenturyLink. And then you can flip between monthly, weekly, daily charts, see the relationships on the cash flows. Is momentum about to turn up? Look at that. Right? That's going to cross over soon. I really think you should be buying CenturyLink down here if you're a growth and income investor. And I don't think they're going to, I think their dividend is fine. And again, they have physical assets they can sell because of 5G, or they can just monetize it themselves over a longer period of time. I think what they're going to do is sell the physical assets and then just become a services company. I think that's what they're going to do. And again, Apple, Amazon, Google, all are getting in, and Facebook are all going to get into this. Somehow they have to. They need dedicated fiber. So somebody's going to buy this because that fiber is irreplaceable. And Google started to build their own fiber network, and they found out it's just too hard to do and too expensive. It'd be cheaper for them to buy CenturyLink, which is one of the biggest fiber networks in the world. I think third or fourth biggest. You know, so I would even think that this is something where you might just want to keep rolling calls on it until it goes up. All right, I'll let you go. A long call today. In the future, these are going to be shorter because we have 2 calls now. Tuesday night is going to be stocks and options, and Fridays is going to be macro and ETFs. But I wanted to answer some questions because of what's going on in the world right now, and read those articles about what's changing from coronavirus. It's not just going to be not shaking hands anymore, right? So I've been giving all my friends the high sign. If you remember our gang, right? Spanky, Alfalfa, the high sign. Been given the high sign. And then the live long and prosper. So I'll be doing a lot of that. Yeah, I'm not going to be doing the elbow bumps. No. I did do it as a baseball player. I'm not going to do it now. But the high sign and live long and prosper, I think that those are going to become my staples. And you know, if they have the World Series of Poker in June, which they shouldn't, they should put it off to October. I will be wearing latex gloves and probably a Darth Vader mask. So we'll see. All right, everybody have a great weekend. The world's not going to end. We can fix everything. It'll come back when it comes back. Sell grandpa stocks because they're on the L shape, and get into the 5G, IoT, AI stuff that we've been looking at. And biotech, I'm going to add a biotech ETF that we can trade a little bit. But for the most part, you know, QQQ is the entry that we're looking for. So let's just finish with QQQ. All right. We got into our first buy zone, broke through it. But I think that the real buy zone, oh, there you go, it's down here. 150 to 130 for QQQ. What are we at today? 164 was the low. Where is the low so far? QQQ is going to get under 150. And at that point, depending on what the downward momentum is, right? So we go to a weekly. Depending on what the downward momentum looks like and what money flow is doing, what this is doing, because this is going to come back down probably next week. It's going to go up. It's up now. It's come down next week. Somewhere in here, we have to be buyers. And we probably want to scale in, you know, 150, then 130. Probably be the 2 buy prices. Because if we put about a third of our money in around 150, 148, 149, right in there, then the rest in the 130, maybe even lower down the 120 range, that means that as it goes up and it gets back up to here again, we can scale out instead of having to pick one spot. It's hard to pick one point, right? So have a range like this and buy near the top and buy near the bottom. And that way you get a good price, right? You know, maybe a third of your money you allocate here and 2/3 of your money you allocate here. And if it hits here, it bounces again, and the world's suddenly getting better, you can add. Because then when it breaks through this, you get all that upside. But risk management first, and then figuring out what to do with the rest of the money as we get more clarity. But the one thing to keep clear is in the long run, it goes up. So don't try to be too precise. You know, even if I mean, I've gotten these pretty close, but maybe we should have traded this week a little bit. I think for most people that would have been a hard trade because convincing everybody to sell by the close yesterday would have been tough. So, all right, have a great weekend. Wash your hands. Stay out of people's faces. And if you haven't followed me on Twitter, usually in the evening when I'm getting a little punchy, I'll put some things up that are maybe a little funny to some people. So this is my favorite tweet of the week. This is my favorite tweet of the week, and I'll leave you with this. Have a good weekend, everybody.